Imagine walking up to a massive, beautifully constructed brick building. The foundation is rock solid.
Right, the kind of place that's built to last a century.
Exactly. And the bank accounts locked in the safe inside. They are absolutely overflowing with cash. The business operating inside those walls is generating more revenue today than it ever has in its entire history.
That sounds like a pretty incredible place to be.
You'd think so, right? But suddenly, everyone inside is sprinting for the exits. I mean, they are tossing the keys away for pennies on the dollar, just trapped in this state of sheer, absolute panic.
Which makes zero sense when you look at the building itself.
Right. And why are they running? Because someone outside yelled that they just invented a new type of wind. And that wind might eventually blow the building down maybe 3, maybe 4 years from now.
The disconnect between the physical reality of that building today and the, psychological terror over what might happen tomorrow is staggering.
It really is. And the financial markets are doing exactly this right now, running from sturdy buildings. So our mission for today's deep dive is to figure out why, pulling from a great breakdown by the financial channel, New Money.
There's a lot to unpack here.
For sure. But as always, we want you to be armed with the best tools to navigate this panic yourself. So before we jump in, a quick note. To access more advanced researches, applications, and our latest published personal intelligent multi-agent deep value intelligence, welcome to explore and join deepvalues.ai community. Track total market temperature. Welcome to search and download iOS app Buffett Indicator from Apple App Store. Disclaimer. All analysis is based on publicly available sources and may be subject to revisions or differing interpretations. All contents from this channel is for educational and research purposes only and does not constitute investment advice. Conduct your own due diligence before making investment decisions. If you like to access wider topics, including life and investing philosophy, please subscribe to our sister channel, Deep Values. Don't forget to like this video. Much appreciated.
All right, so that paradox you just described, it is playing out across the entire software industry.
Yeah, financial media has started calling this moment the SaaS apocalypse. SaaS standing for software as a service.
It's a dramatic name, but it fits. I mean, we are watching absolute giants of the industry, companies that form the digital backbone of the modern economy, just getting crushed.
We're talking massive market cap wipeouts, right?
Oh, absolutely. Reductions of 30, 40, 60, and in one extreme case, an 85% drop.
Okay, let's unpack this, because the businesses themselves have not collapsed.
Not at all.
If you look at Salesforce, Adobe, Snowflake, Atlassian, these are the companies caught in this crossfire. Their customers aren't suddenly closing their accounts en masse.
Right, the churn isn't there.
Exactly. Revenues are still growing, often in the double digits, and many of these entities are printing free cash flow. So we're looking at a scenario where investors are behaving as if beautiful, high-margin software is suddenly a dead industry.
Because the market isn't having a panic attack over bad balance sheets. It's having a panic attack over a profound shift in the future narrative.
The AI narrative.
Precisely. It's the looming shadow of artificial intelligence. Investors are desperately trying to model out what AI means for the future unit economics of these businesses. And, well, the uncertainty of that math is causing them to just hit the eject button.
Which means before we start looking at the individual casualties of the sell-off, we need to understand the mechanics of the fear itself. I mean, why does the invention of AI suddenly make software look like a toxic asset?
So there are two distinct structural fears driving this dread. The first is what we can call the fear of consolidation.
Consolidation, okay.
Think of this as the beast AI platform theory. Look at how a modern company runs its customer support today. They don't buy one tool.
Right, they cobble things together.
Exactly. They might pay for Zendesk to manage the tickets, Intercom for the live chat, Salesforce Service Cloud for the database.
And maybe another tool entirely just for analytics. They're essentially duct taping 5 or 6 different software subscriptions together to create a single workflow.
That's a perfect way to put it, the duct tape of enterprise software. But investors are looking at the rapid evolution of AI agents, these autonomous tools that can process natural language, handle complex ticketing, respond to customers directly, all without human intervention.
Wow. So the fear is that instead of renewing 5 different specialized software subscriptions, a business will just subscribe to one single overarching beast AI platform that does everything natively.
You got it. The duct tape is no longer needed, and those specialized subscriptions simply evaporate.
I mean, that is the existential threat right there, the idea of complete replacement. But there's a second fear too, right? And it isn't about the software being replaced at all. It's about the traditional software business model fundamentally breaking.
Yes, the per-head pricing trap.
That's the one. Let's talk about the per-head pricing trap.
This is really the absolute core of Wall Street's anxiety. The vast majority of these software giants don't sell a flat-rate product. Their revenue is tied directly to a per-head pricing model.
Right. You purchase a basic subscription for your small team or maybe an enterprise lifestyle that covers 500 employees.
Exactly. So the revenue growth of the software company is inextricably linked to the headcount growth of their customers.
It is essentially a headcount tax. The more people you hire, the more you owe the software vendor.
So consider what happens if AI actually delivers on its promise of making businesses vastly more efficient. A marketing agency using Adobe or a sales team using Salesforce might realize that with generative AI handling the heavy lifting,
They no longer need 100 employees in that department.
exactly, they can achieve the exact same output with 50 people.
Wait, so the moment that agency reduces its headcount to 50, the software vendor experiences a 50% reduction in sellable licenses overnight.
That's the fear. The customer might still love the software, but the revenue potential for the vendor is permanently impaired.
Okay, I hear that logic, but I am going to push back on the scale of the panic here. Let's use an analogy.
Let's hear it.
Think about a family gym membership. Just because someone goes out and buys a state-of-the-art home treadmill, which is the AI in this scenario, that doesn't automatically mean they cancel their multi-person gym membership the very next day.
Right, because there's more to the gym than just running.
Exactly. Maybe they still rely on the gym swimming pool, the heavy weightlifting equipment, the community classes. Enterprise software is incredibly sticky and multifaceted. A company isn't going to instantly cancel thousands of licenses just because a new AI tool can write a basic email.
That's a great point.
So are we confusing an eventual threat with an existential threat?
The gym analogy perfectly illustrates the flaw in the market's current logic. See, the market operates as a discounting mechanism. It attempts to price in all future events today.
Which means they tend to overreact.
Oh, massively. What we are seeing is a fear of future efficiency, leading to a massive indiscriminate sell-off today. Investors are dumping fundamentally sound, highly profitable businesses because they are terrified of a theoretical reduction in licenses, 3 to 5 years down the line.
They're basically pricing in a 100% gym cancellation rate based on the mere invention of the treadmill.
Exactly. That's exactly what's happening.
Well, let's transition from the theoretical fear of this beast AI and look at the actual behemoths that have been swept up in this apocalypse. We need to start with the giants that possess massive, deep-seated protective moats around their businesses, specifically Salesforce and Adobe.
Two companies that are highly profitable, deeply entrenched as industry standards, and yet
Caught in the exact same downward spiral as highly speculative startups.
it's wild.
It really is. I mean, if you are listening to this and you've ever filled out a form on a corporate website, only to suddenly find your inbox flooded with sales emails aggressively trying to get you on a phone call.
You have Salesforce to thank for that infrastructure.
Yep, you really do. They are the ultimate undisputed customer database. They cater to entire sales teams, marketing departments, and customer support divisions globally.
And despite that dominance, their stock price was halved, slashed by 50% from its peak in December of 2024.
Which is wild when you look at their actual footprint. They hold anywhere from 20 to 24% of the global market share for customer relationship management.
They are miles ahead of Microsoft, who sits in second place.
Right. And when you lift the hood and look at the underlying fundamentals, the numbers completely contradict the market's panic.
The disconnect is glaring. Over the past 3 years, Salesforce's revenue, earnings, and free cash flow have consistently trended up and to the right.
There has been a slight moderation in their growth rate since 2022, sure, but
But a slight moderation in hypergrowth does not mathematically justify a 50% reduction in the share price.
Yeah.
Furthermore, their balance sheet is fortified, their debt-to-equity ratio is incredibly low.
like roughly 2/3 of their total debt could be paid off immediately using just the cash and equivalents they have sitting on hand today. That's not a company in trouble.
Not at all. And the narrative for Adobe is almost a carbon copy.
Adobe, right. This is the creative and marketing engine of the entire internet. Their stock is down over 60% from its 2022 peak. But look at their actual utility. They completely own the PDF workflow with Acrobat.
They own the creative standard with the Creative Cloud Photoshop, Premiere Pro, Illustrator.
Yeah, entire industries are built on top of their file formats. You can't just stop using them.
Furthermore, they have massive marketing, commerce, and analytics tools sitting on top of that creative base with the Adobe Experience Platform, which allows global brands to run campaigns and harvest data.
And just like Salesforce, Adobe's financial results are pristine.
Revenue, earnings, free cash flow, all continuing an upward trajectory. Their total debt could be wiped out instantly with their current cash and treasuries.
So there is absolutely no fundamental warning sign in their financials today that suggests a company in crisis. Which brings us to something really interesting.
What's that?
If you run a discounted cash flow analysis, the math screams that these companies are incredibly undervalued. You project their future cash flows, discount them back to today's value, and factor in those pristine balance sheets.
And the current stock prices look like absolute theft.
Right. Which begs the question, if the math is so overwhelmingly positive, why is the market completely ignoring it?
What's fascinating here is the sheer ruthlessness of market psychology overriding fundamental analysis. Both of these companies possess what we call a deep switching moat.
A switching moat, which means once a company integrates Salesforce or Adobe into their daily operations, ripping it out becomes agonizingly difficult.
Agonizing and expensive.
Yeah. If I'm running a 500-person company, moving away from Salesforce means I have to migrate years of sensitive customer data, retrain my entire staff on a totally new interface, and basically disrupt my revenue-generating workflows for months.
The cost of switching is simply too high. That switching moat protects the business's revenue today, and it will likely protect it tomorrow.
But the stock market doesn't trade on today's guaranteed revenue, does it?
No, it trades on the future narrative. When the broader macro narrative shifts to, AI is going to destroy the per-head pricing model, the market stops caring about how wide your moat is.
The fundamental math gets shoved in the trunk and pure psychological momentum takes the wheel.
Perfectly said.
Now, a protective switching moat is an incredible defense mechanism if you are a mature, reasonably priced company, but moats offer absolutely zero protection if your stock price was built on an unsustainable fantasy to begin with. Which brings us to a totally different category of victims in this sell-off. Let's examine the companies facing a brutal double whammy. They are dealing with the AI fears, plus the incredibly painful transition from being a hypergrowth darling to a mature company.
This is where the valuation destruction gets truly historic, because we have to factor in the euphoric zero interest rate environment of 2021 and 2022.
Let's focus on Atlassian. They're the premier workflow managers.
If you work anywhere near software development, you know Jira.
Exactly. You likely use Confluence or Trello. This is the software that tracks what engineers are building, who is assigned to fix which bug, and how agile development projects are moving forward.
But the bleeding here is severe. The stock is down an astonishing 85% from its high in late 2021.
85%.
Yeah. And even looking at a shorter time frame, since February 2025 alone, the stock has plummeted roughly 78%.
To understand a drop that catastrophic, we really have to look at the environment that created the peak. Back in 2021 and early 2022, money was essentially free.
Investors didn't care about standard bottom-line profitability, what we call GAAP earnings.
Right. They only cared about total market capture. The logic of the era was to acquire every possible user on Earth at whatever cost, assuming you could simply turn on the profit spigot later.
And during that euphoria, investors gave Atlassian a $15 billion market cap, despite the company producing zero GAAP earnings.
Zero GAAP earnings? That's just wild.
Investors were pricing them purely as a hypergrowth phenomenon. Their price-to-sales ratio, which is the premium investors pay for every single dollar of sales the company generates, was over 40.
Which is an astronomical premium.
Today, as their growth has naturally slewed to more mature, sustainable levels, that multiple has violently contracted. That price-to-sales ratio has collapsed from 40 down to just 3.
Ouch. Then you layer the AI narrative on top of that multiple contraction.
Exactly.
The specific fear targeting Atlassian is that generative AI could drastically reduce the need for human software engineers. If AI agents are writing the boilerplate code, running the quality assurance tests, and fixing the basic bugs, development teams will shrink.
And fewer human engineers means fewer human beings who require a Jira license.
Right. It is the exact same per-head pricing trap we discussed earlier with marketers and salespeople, just aimed directly at coders.
And we are seeing a different flavor of this hangover with Snowflake, the massive data organizers.
Yes, Snowflake. The entire premise of their business is that if AI is this incredibly hungry machine, Snowflake provides the infrastructure to organize the data it consumes.
You would think they would be immune to the panic.
You really would. Yet, even sitting right in the middle of the AI boom, they are down 60% from late 2021 and down 30% just this year.
And remember, during the peak of the boom, their price-to-sales ratio was over 100. People were happily paying $100 for every $1 of sales.
That's just a recipe for disaster.
It was. But Snowflake faces a uniquely different threat narrative. Their primary risk isn't that a standalone AI agent will replace their software.
Right. The fear is that the massive cloud infrastructure giants like Amazon Web Services, Microsoft Azure, Google Cloud will eventually build their own internal, highly optimized data organizers, rendering Snowflake redundant.
Exactly, it's the big tech threat.
But I have to step in again and defend the actual survival metrics of these businesses. Yes, neither Atlassian nor Snowflake have standard GAAP earnings. They are not turning a traditional bottom-line profit yet. But look at their cash runways.
They are massive.
Right. Atlassian is sitting on $1.6 billion in short-term cash and treasuries against only $1 billion in debt. Snowflake is in an even stronger position, holding $4 billion in cash and investments against $2.3 billion in debt.
Both of these companies have years of runway to adjust their strategies. They are completely insulated from any immediate existential threat of bankruptcy.
It feels like investors bought a Ferrari during the hypergrowth phase. They paid a massive premium for top speed.
And now
the car is cruising at a totally normal, reliable 60 miles per hour, and investors are irrationally angry that it requires the basic, boring maintenance of a regular commuter car. You don't scrap a perfectly good vehicle just because it's no longer breaking land speed records. Does dropping from hypergrowth speeds to steady growth justify an 85% wipeout?
if we connect this to the fundamental math, the underlying operations simply do not justify the severity of the sell-off. Revenue growth for both these companies remains steady.
And their free cash flow generation is stabilizing.
Exactly. When you run those same discounted cash flow calculations we applied to the behemoths, you see steep discounts to intrinsic value here as well. Current estimates suggest Atlassian is trading at roughly a 67% discount to its true value.
Wow, a 67% discount.
Yeah. What we are witnessing is the market aggressively, almost vindictively, punishing these companies for the valuation mistakes investors themselves made 3 years ago. The AI narrative is simply providing a convenient excuse to initiate the dump.
Okay, so what does this all mean for you, the listener? We have traversed the entire landscape of this panic. We started with the macro fear of the beast AI consolidating workflows.
Then we looked at the highly profitable titans with deep switching moats, like Salesforce and Adobe.
And we examined the hypergrowth hangovers of Atlassian and Snowflake. So how do we synthesize all these moving parts?
The grand takeaway is that every single layer of the software ecosystem is undergoing a violent repricing. The platforms that manage customers, the tools that empower creators, the systems that track workflows, and the databases that organize information, they are all caught in the exact same psychological storm.
It's incredible.
It is. But what this deep dive truly reveals is a total breakdown of the efficient market hypothesis. The idea that stock prices perfectly and rationally reflect all available information is falling apart before our eyes.
Because markets are ultimately driven by human beings, and, well, human beings are incredibly prone to emotional extremes.
Extreme volatility and knee-jerk reactions create profound mispricings. The market is currently confusing the uncertainty of AI's future impact with guaranteed doom for the software industry.
Right.
Historically, when the market indiscriminately throws out financially sound, cash-generating businesses because of a shift in the broader narrative, it creates massive opportunities for long-term value investors who are willing to run the math instead of following the herd.
It is the ultimate test of doing your own homework, which is why we have to reiterate the core message from our new money source material. These are not guaranteed red-hot buys. We aren't suggesting you empty your portfolio into software stocks tomorrow morning based on a single deep dive.
Please don't do that.
Right? Definitely don't. But if enterprise software sits firmly within your circle of competence, if you truly understand how switching modes protect revenue and how per-head pricing models function now, is the absolute best time to dig in and do your due diligence.
Absolutely.
And again, leveraging tools like the deepvalues.ai community and tracking market temperature with the Buffett Indicator app are fantastic ways to run those analyses.
It demands the discipline to look past the noisy headlines and focus entirely on the underlying mathematical reality of the business.
But this entire conversation circles around an underlying premise that Wall Street seems to be treating as a spiral math equation. We spent this deep dive analyzing the market's biggest fear, the loss of software licenses.
Right, the per-head pricing trap.
Exactly. A company downsizes from 100 employees to 50, so they purchase 50 fewer licenses. Wall Street is panicking over the lost subscription revenue. But what do those canceled licenses actually represent in the real world?
This raises an incredibly important and honestly chilling question. Every single one of those canceled software licenses represents a real human job.
A marketer, a software engineer, a customer service representative.
Exactly. If Wall Street's fear is correct, and generative AI truly does eliminate the need for millions of those human licenses over the next decade, what does that mean for the broader economy when those salaries disappear?
It's a huge blind spot.
The market is hyper-focused on the software companies losing revenue. But perhaps they are entirely missing the larger societal earthquake. The people running out of the building are the ones who actually get swept away?
Man.
Are we worrying about the wrong apocalypse? It is something to seriously think about.